Hello and welcome back to Kitco Mining's Digging Deep with me, Paul Harris, in which we take a closer look at some of the most interesting news items in the mining and exploration space. Joining me today is David Erfle, founder of Junior Miner Junkie. David, welcome back to Kitco.
Thanks a lot for having me, Paul. Always great to talk to you.
And we've got some very great, interesting things to talk about. M&A action. We're going to kick off with that. Coeur Mining is to buy Canadian gold producer New Gold in an all-share $7 billion deal with a 16% premium, which it says will create a $20 billion precious metals company focused on North America. The combined company will produce an estimated 20 million ounces a year of silver, 900,000 ounces a year of gold, 100 million pounds of copper, and for about a 1.25 million ounce of gold equivalent. Coeur said creating a larger company provides potential for additional exchange-traded fund ownership and eligibility for larger generalist investors. David, more consolidation in the mid-tier gold space. Are transactions like this necessary? And if so, why?
Yeah, I mean, it's similar to that Equinox Gold buying Calibre merger earlier this year, where the smaller company is lower cost and adds greater value to the higher cost than the bigger company. So, you know, when that was announced, Equinox shareholders were mostly positive on the deal, while at the same time, Calibre shareholders were generally disappointed because integrating Calibre's operations, Equinox Gold gained access to an experienced production base that lowered their all-in sustaining costs significantly. But Calibre shareholders felt the deal would basically undermine their growth trajectory during a critical development phase. I mean, Calibre was nearing completion of its Valentine gold mine, which would significantly lower total mining costs for the company. And Van Eck was Calibre's largest shareholder at the time and opposed to the deal, believing that the merger would dilute the quality and potential of Calibre's assets and basically, in turn, weaken Calibre's intrinsic value. If I were a shareholder of either Coeur or New Gold, I wouldn't be happy with this deal at all, Paul. And basically, judging by the share price reactions of both CDE and NGD, the market doesn't really like it either. I mean, on the heels of significantly beating Q3 expectations, with production totaling 115,000 ounces of gold at an all-in sustaining cost of $966 an ounce, and New Gold hitting a 12-year high, the company is being taken over by Coeur, whose shareholders have experienced excessive dilution over the past 20 years. I mean, from a share price high of $75 in 2004, CDE is now trading at over 80% lower following the announcement of yet another highly dilutive deal. I mean, I would imagine that growth via excessive dilution and no dividend has kept Coeur shareholders very frustrated, Paul.
Well, let's dig into that a little bit more. Your reference to Equinox Gold, I think, is a good one. Equinox just reported its third quarter results, which includes the first full quarter of having the Calibre mining assets within its portfolio. And that's helped drive their all-in sustaining costs down by 6.5% to $1,833 per ounce. So the higher cost, bigger company buying the lower cost, smaller company makes a lot of sense. In this instance, even more so because effectively it was an RTO because the Calibre Mining senior management team took over running Equinox Gold. However, and so in the instance of Coeur and New Gold, Coeur buying the low cost New Gold, which, as you said, $966 per ounce, all-in sustaining cost in third quarter, that's going to really cut into Coeur's all-in sustaining costs. But there's no management change. And so the question is, what is in this for New Gold shareholders?
Right. Yeah, exactly. And there's a huge break fee on both ends. So I don't see this deal. I don't see anybody else coming along and making a bid for New Gold here.
Okay, well, hopefully the deal will enable Coeur to generate lots and lots of free cash flow and maybe to start a very aggressive share buyback program to sort of cut into that share dilution you were talking about. Coeur completed an all-stock $1.7 billion acquisition of Silvercrest Metals in February to obtain the Las Chispas mine in Sonora in Mexico. Las Chispas is one of the world's highest grade lowest cost and highest margin silver and gold operations. At the time, Coeur said this would materially strengthen its balance sheet from day one. And if that's the case, David, it seems Coeur's been effectively leveraging that new balance sheet potential into a larger prize in the shape of new gold.
Right. Right. I mean, it's like I said, they're growing via dilution, and they're not offering a dividend at the same time. So, if you're a long-term core shareholder, you're seeing the share price going up with the gold price, with the silver price. You're happy, and then all of a sudden, a big dilutive growth addition comes along and takes the share price right back down again. Like I said, I mean, the share price at one point was $75 per share in 2004, and it got all the way down to around $2 or $3. I mean, that is what, like 96% loss of the share price in a bull market, in a secular gold bull market. So, like I said, if you're a legacy core shareholder, you're not really happy with growth via massive dilution without getting a dividend.
Mexican precious metals producer Fresnillo is to buy gold, Abitibi gold explorer Probe Gold for 780 million Canadian dollars at a 39% premium. I think that's one of the highest premiums paid in recent times. David, this transaction is really out of left field, given that Fresnillo has no presence, infrastructure, or experience in the Abitibi. What was your impression of this?
Yeah, I mean, as you know, Paul, Probe's been a top 10 holding in my JMJ newsletter since my subscribers and I began accumulating the stock just after a spike pandemic-induced low in April of 2020. So, although this deal basically gives us a nice four-bagger win, we pretty much feel this transaction does not reflect the full value of Probe's 10 million ounce high margin Novador asset, especially with gold trading around $4,000 an ounce. I mean, Fresnillo is paying just around $58 per in-ground gold ounce, located in a top-tier jurisdiction within a district-scale size land package. But on the plus side, on the more plus side, besides the four-bagger, the low $31 million break fee and an all-cash offer makes it easier for us to basically sit around and take a wait-and-see approach while hoping for a more competitive bid before this deal is expected to be completed in Q1 of next year. I mean, with Agnico Eagle being the dominant operator in the Abitibi, we're basically hoping for a more competitive bid from them, or possibly even Kinross, who paid nearly 3 times more for the Dixie project in Red Lake by acquiring Great Bear Resources for $1.4 billion without as much as a defined resource, when gold was trading 50% lower in late 2021. I mean, but by the time Kinross had published an MRE, they had paid 5 times more per in-ground ounce than Fresnillo is getting Novador for, which Probe has already proved up, like I said, to 10 million gold ounces, and is set to publish a PFS possibly before the deal is expected to be finalized early next year. I mean, after a solid Q3 was released this week, Kinross has $1.7 billion in cash and total liquidity of $3.4 billion. So they can easily afford to make a better offer for Probe.
I mean, there's so many questions around this. As you mentioned, Probe is in Agnico Eagle Mine's backyard. The Abitibi is pretty much Agnico Eagle's backyard. There's also Eldorado Gold operating there. It's a 12% shareholder of Probe, although they signed an agreement to say they'll vote their shares in favor of the Fresnillo transaction. Given Fresnillo's lack of presence in the Abitibi, David, is its game plan possibly to advance the project maybe into development, or to advance it, add some value, and then look to flip it to Agnico, the obvious buyer perhaps, or Eldorado, or maybe even somebody else, as you suggested?
Yeah, I mean, hey, like I said, it's a low break fee also. So, they make this bid, and somebody else comes along, they make $31 million without doing anything. I mean, like you said, Eldorado controls 12% of Probe's outstanding shares, and they support the deal. This basically leaves Agnico as the most likely to make a competitive bid. I mean, Agnico's 60-ton per day Malartic mill is expected to have 40,000 tons per day spare capacity from 2028, and Novador is only 50 kilometers away and is expected to be shovel ready by 2028. And it's expected 50,000 tons per day feed could help fill that mill, while Agnico is already looking at regional tolling ore hauls from their Wasamac and Upper Beaver projects, and that's 90 to 130 clicks away. I mean, Probe's chairman of the board, Jamie Sokolsky, he's currently the lead director on the board of directors at Agnico. So this suggests that Agnico was pretty aware of the negotiating process to sell the company. So maybe they're waiting to see how much another player was willing to pay, and they're now planning to make a more competitive offer as the company can afford to do so, like Kinross. I mean, they've got even more cash. They've got $2.2 billion in cash after a record Q3 was announced last week. I mean, Wesdome is also an operator in the area, but they're a mid-tier gold miner, and they don't have the capacity to dedicate this much cash for a competitive offer. I mean, the offer was $365 by Fresnillo, and the deal was accepted. So a break fee of $31 million would make it about another 14.5, 15 cents. So a competitive deal's got to be at least $3.80 per share to cover the break fee.
David, in some ways, this perhaps has echoes of Canadian Malartic's history. It was being developed by Cisco. A hostile bid came in. White Knights rode in the shape of Agnico Eagle Mines and Yamana Gold, and subsequently, Canadian Malartic has become one of the flagship operations for Agnico Eagle Mines. With this deal, as you mentioned, with the very low break fee, could this be a tactic or a strategy to, perhaps force Agnico's hand to buy Probe? Because, in the region, in the district, Agnico does have a fill the mine strategy.
Mm-hmm. Yeah, it could be. I mean, Agnico took out O3, remember, recently. I mean, we were O3 shareholders also. We didn't get a very big premium for that, but at least we made some money. But that's another bid to possibly fill the mill from Marban to Malartic.
Okay, we've talked a lot about Agnico Eagle's backyard. Let's talk a little bit about Fresnillo's backyard and what this deal perhaps says about on the company's view on Mexico. The obvious question is, why buy Probe when it could have bought Mag Silver a while back to consolidate its ownership of the Juanicipio silver mine, which is right in its backyard, but it didn't.
Yeah, with the recent problems in Mexico, I know it's been around permitting, not around functioning mines that are permitted. I expect they want to diversify a little, and come into an area that is highly competitive. So I would imagine that's the reason why they're doing it. But like I said, I mean, it's only a $31 million break fee. So if somebody comes in and overbids them, they made $31 million for doing nothing.
Okay. Now, a forward-looking statement or question for you, David. What are you going to cycle? Any initial ideas on what you might recycle your earnings on this deal into as a new investment opportunity?
Well, I don't really have to think about it yet. I mean, that's what's so great about a cash offer, right? The share price is going to continue to trade at around 365. It's trading a little bit higher right now because I think the market probably feels like I do that there's going to be another offer. I mean, as soon as the offer was announced, I think there was a bid there was a buyer at 374 a share. So there are others out there who feel the way I do. But it wouldn't make sense, even if I didn't expect another bid, it wouldn't make sense for me to sell it until Q1 when it's expected to close, because I would immediately have to pay capital gains tax instead of having to wait until the beginning of next year and delay those capital gains taxes. But I digress. As far as what I'm going to buy, hopefully I don't have to make that decision until even farther than Q1, because I'm hoping to tell you the truth, I'm hoping for a bidding war for this. I mean, this is a criminally low price for this project, so I'm hoping for a bidding war in a strong bull market. That would be ideal, and then I wouldn't have to sell my shares until late Q1, early Q2, and then I'll have to take a look at what the market is telling me of what I should buy then. I mean, right now, the highest beta is in the higher risk, earlier stage juniors. Juniors that have just published a mineral resource or just published a PEA. So and optionality plays that are in the same boat. I like companies like that, and also I wouldn't be surprised if I added a little more copper exposure to a copper junior.
Okay, now not an M&A, but perhaps a prelude to one. Gold Fields made a 50 million Canadian dollar strategic investment into Suriname Gold Explorer Founders Metals at a 14% premium. Founders is exploring the Antina Gold project in Suriname. The investment comes about a year after fellow gold major B2Gold made a similar strategic investment of $12 million to take a 5% stake in Founders. B2 made an additional $10 million strategic investment this week into Prospector to lift its ownership there to 17.2%. Prospector is operating in Canada's Yukon Territory. David, M&A is heating up, obviously, and so are majors investing in juniors. Given that everything's heating up, why make strategic investors rather than buying a junior outright at what presumably will be a lower price than it will be in the future?
Yeah, well, it's all about timing in these companies, right? I mean, strategic investments by majors and mid-tier miners and early stage juniors make sense for companies looking for future growth. I mean, Goldfields already has their hands basically full with existing material growth in its pipeline after recently purchasing the other half of Gruyere that it recently took over in the Gold Road acquisition in September. And basically, also they ramped up to near peak production levels at the Solaris Norte project in Chile. And remember the addition of Windfall production in 2028, which is a 300,000 ounce per year asset in Quebec. So it basically makes more sense for a company like Goldfields to make a strategic investment in Founders as their Antino gold project in Suriname. It's a high risk grassroots early stage asset. So if Founders eventually proves to be successful in de-risking this project to a positive economic study, then Goldfields can choose to eventually buy out the rest of the company after taking a strategic investment of a small percentage in it.
Okay, thank you, David. Let's turn to copper, where Solaris Resources has just released a PFS with an updated resource estimate and maiden reserves for its Warintza copper project in Ecuador. Warintza will produce an average of 205,000 tons per year of copper equivalent over 22 years, following initial capital investment of $3.7 billion US dollars. That gives it a capital intensity of just over $15,000 per ton, which is pretty good. Over the first 15 years of production, it will also produce annual byproducts, including 6,500 tons per year of molybdenum, 57,000 ounces a year of gold, and 1.3 million ounces a year of silver. The project will yield an after-tax internal rate of return of 26% and a 2.6-year payback. Another solid economic study there, David, from Solaris. We've seen a spate of these recently with Aldebaran Resources, McEwen Copper, Arizona and Sonoran Copper, and Ivanhoe Electric all coming out with studies in recent months. Why is everybody getting copper studies out now, David?
Well, the coming copper crunch has quality junior late-stage developers. They're de-risking these large, high-margin copper porphyry projects. And evidence of a coming copper supply deficit is, remember it's September, the Grasberg block cave shutdown at the world's second largest copper mine. And more recently, a major copper miner, Glencore, announced that production is down 40% since 2018 last week.
Okay, so despite there's a forecast copper deficit, there's been relatively little M&A activity in the copper space. Why do you think that is?
Well, we've seen some signs of M&A in the copper space with the Agnico Tech merger that was announced the last time we spoke in Beaver Creek in September. This is a $53 billion all-share merger that would create the world's fifth largest copper producer if the regulators in U.S. and Canada and I think China sign off on the deal. But I'm surprised as you that another competitive bid has not been made for Teck as of yet, and that there's not been more M&A in the copper space since then.
Okay, I would imagine the Chilean regulator also has to chime in there as well. With copper prices around $5 per pound and potentially going higher, I've heard the argument that there's not really a need for new deposits, as copper porphyries have lots and lots of material at 0.35% copper, 0.3% copper, and can produce a shed load more at 0.2% copper. As copper prices go higher, this vast amount of tons starts to become economic. What's your view about that argument, David?
Yeah, well, this is a fair argument for reasons why we may not see more M&A in the copper space in the short to intermediate term. But I would argue that the large high margin copper projects that you just mentioned, they're eventually going to be taken over by a major global copper miner. I mean, in full disclosure, Paul, my JMJ subscribers and myself are shareholders in Arizona Sonora, and we're very happy to continue holding the stock in hopes of a more distant future takeover at a much higher price. I mean, one always would rather see the share price of a junior run much higher on its own before an expected premium to market offer from a major or a mid-tier miner to take over the company is eventually presented.
Okay, thank you, David. Let's close with a look at some of the third quarter results. We're in the middle of third quarter results reporting season. Many gold companies reporting record free cash flow, record shareholder return, adding severe amounts of cash to their balance sheets. Newmont's got, I think, over $2 billion sitting in cash sitting on its balance sheet now. Shareholder returns are increasing as well. Kinross Gold this week reported, and its dividend, it's increasing its dividend. Shareholder Gold has also reported it's increasing its share buybacks. David, when you look at the third quarter results, what encourages you this season? And conversely, is there anything that discourages you about how companies are adjusting their capital investment, their capital deployment strategies?
Right. I mean, it's all, this is all good news for long-term shareholders of Kinross, especially because they raise their dividend. But with the stock having tripled year to date, it appears that all these blowout Q3 earnings reports from Kinross and these other majors and mid-tier miners, they've already been priced in. These stellar Q3 financial reports, they're coming on the heels of an 11% correction thus far in the gold price from a mid-October peak at nearly $4,400 an ounce, and a 16% correction in the silver price from a recent all-time high above $54 an ounce. For $54 per ounce. So with the precious metals mining sector providing roughly 2 times leverage on the upside year to date, the GDX has now corrected roughly 20% on the downside thus far, after being up over 120% into mid-October year to date. And so this has been par for the course as far as the correction on the downside. Kinross shares, however, they're down just 15% from a mid-October peak near, I think, $28. As KGC, the ticker symbol, they've outperformed peers this year. But with silver and the miners continuing to show relative weakness to the gold price this week, we could see the next technically strong support level at 3,750 to 3,700 in gold being tested before this correction of recent major outside gains has ended. But I think while it's happening, we're going to see more M&A. I think more of these companies are going to take advantage of these price downdrafts to take a run at some of these companies.
Yes, and you've got the trifecta, haven't you? Or you've got the growing cash positions. The bigger companies, they've had greater share price appreciation than some of the smaller companies, so there's some leverage in their stock as well. One thing that amused me with Kitco's with Kinross's results was how they got cute with announcing their dividend increase. They announced it as a 17% increase, and so I rushed to open it. Like, wow, but it was 3 cents to 3.5 cents.
It's all in the headlines, right, Paul?
Absolutely. You make a very interesting point a moment ago, David, about the correction. You know, the fourth quarter so far has been quite choppy in terms of the gold price, and some big pullbacks, and it recovered and a pullback again. What do you expect? What impact do you expect that will have on fourth quarter results? Because if this continues, that average gold price for the quarter is perhaps not going to be as healthy as it was in the third quarter.
Well, if it stays around $4,000 an ounce, mostly during the quarter, it's still going to be a healthy, $400 higher than Q3. I mean, the gold price went from $3,000 to $4,000 in 7 months. So, I mean, a lot of these gold stocks still basically, if you're talking about the higher risk juniors, they still haven't caught up to the majors. And as far as the majors are concerned, they're still trading at 7 times cash flow, when back during the last bull market into 2011, they were trading at 10 to 15 times cash flow. So the general public, the general investor, still hasn't fully embraced this sector yet.
Well, this is true. There's potentially a lot more to come, but not from us. From us for this week. That's it. David Erfle, thank you very much for joining me today.
Absolutely. Always a great pleasure, Paul. Always wonderful speaking with you.
Likewise. And for our viewers, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.